All right, ladies and gentlemen, my name is Ben Safepal. Jimo, I'm the team leader of Plan B Xpress. Some of my community members have reached out to me and had said the video I did about intraday trading strategy and especially on currencies, why you don't need to over-label yourself. There are so many strategies you can do, but I always love that you don't over-label yourself over strategy. As you all know, we always mark weekly key level. If you have not watched the way we do that, you can go back to our channel and watch some of those how to mark weekly key levels. Okay. Now we have said trading is very simple. If you can actually align with your good belief system and what goes in your mind, with your strategy. Now, first is that if I'm going to trade, there are things that are very paramount. First thing you want to identify trading is that okay, you have seen the structure. You have seen the instrument you want to trade, and I've said beginner don't trade too many instruments. Maybe Euro USD is better for you as a beginner, USD JPY, and probably GBP USD and stuff like that. All right. So now the first thing that you want to identify is the structural bias. Okay, is the structural bias. Structural what? Bias. Structural bias and trend. Structural bias or order flow. So where is the market coming from and where is it going to? After this, you now have to. So this is your higher time frame structure. So where is the market coming from? Where is it going to? So next, you want to find your POI. So there are so many ingredients of your POI. So I'm not going to go too much about this. So these are the two things that come to your mind when you come to the market. Those of you who are in our ecosystem, I've taught you about what you need to identify about the point of interest. You have external and internal liquidity to identify your point of interest. There are many of them like that. Okay. So now, as a day trader or as a day and intraday trader, so on currencies and all of that, look at this instrument. This instrument is USD CAD. Now we sold this market down last week. Many probably wouldn't understand. We sold it down last week. And then you understand clearly that this market, your bias. So what's my structural bias on this market? On a plain slate, as you come, you know that these are not trend. You're asking, Felix, how do you know? You're knowing trend by the structure. That's what I say structural bias, by the structure. Especially when the market has established one swing, opposite direction, that is swing high, swing low, swing high, swing low. So if it's an uptrend, you should have a swing low, a swing high, a swing low, a swing high. Now, this is where most people get confused. If you look at this now, we have a swing high, we have a swing low here, we have a swing high. Then we have another swing low, we have another swing high. So this is not correct. This is an internal structure because this already established a high. So if that is the case, if you look at this market now, if you want to even get it correctly, as a day intraday or day trader, don't want to give yourself stress, take your part. So look at it. A low, a high, the last place. So impulsive and a corrective. Now, so imagine when you are going up, what happened? You got here, you now want to measure, you can't measure it. So that means this is not a swing high on this structure. This is the swing high. So this is swing low. This is not a swing low on this structure. This is a swing high. Right? This is not the swing low, because I think this one is still lower. So this is not a swing high. This is not a swing low. So if we go by this now, this is daily time frame. Probably we can have this like this. Now, but see now, see what happened. This now become internal. So that means this is the swing high. Then we have a swing low. Then we have a swing high. You understand? So I'm sure it's so cumbersome. Most time we get confused in this all those internal. So if you look at it now, I've identified this structure. If you want to make it a lot easier for yourself, you can do like this. But like I stretch it out. Do you understand? But like I stretch it out. Do you understand? But like I stretch it out. So because of what we call an overlap. Right? Because of an overlap. Are you seeing something? So you've gotten a structure. So this is a low, this is a high. Then let's get all the lows here. This is a low. Right? This is a low. Of course, remember there's a low at the bottom here. This is not a low. Why? This is the one that gave birth here. That's not your low. This is your low. This is your high. Okay? Okay, so which one is lower? So we've come here. We move here. So which is your high? So this one still forms part of this structure. So this is your high and low. So we have this now. Or does that mean this one? So if this one is lower than this, then that means this is your in another one, because you have to check it properly. So let's take this guy off and see. So that means what you're going to have here is this one here. Here, okay, I think we're still in order. Yeah, we're still in order because this is the low, this is a high, this is a low, this is a high, this is a low. Oh, this is a high. Okay, so that's what really happened. Okay, so let's take it back and properly check it so that you will not miss it. Because I think this one is lower than this. So you're going to have something like this. A high, a low, this one, no. You understand? So this one, no. So here, you get it now? A low. Yeah, I think we're in order, sorry. Oh no, okay, this is the real low. A new low here. Sorry about that. Then a high. A low. So this is not the high. Because not up to this. So we have this. Okay, we can take off all of this small one. So this small one, this is not validated again. You know what will happen now? So that's to say we have, so in a nutshell, you have an uptrend. Now, if you have identified an uptrend, so you don't want to trade. So ordinarily, what do? You go buy. So the point of interest, there are so many point of interest you have here. So you have here this is a low, then market move up. This is another block mitigated. That's what we call origin, okay? All of this point we refer to them as what? As origin. So here, before the impulsive move happened, that was it there, okay? Then the market of clearly travel. Now, probably I know you are in the market here, targeting this high. Remember this daily candle. So definitely you will have exited this trade. And now the market came back and come back to this point again. Probably this is an other block. Now, and again, and a support to other block that was mitigated. Then we broke a structure, make a lot of sense. Now, when this structure was broken, you're actually expecting the market to come here. But there's a confluence here of a place that interlude this point, and that's what you're finding here. I'm not going to go to detail about this. Then the market continued, it broke a structure, point of interest correctly, mitigated, and then you have another. I think this guy has this similar kind of a thing. A break of structure, so you just have into confluence of this, right? Okay, all of these are internal structures, so this is a new break of structure. Now, if you look at this guy now, so what you're looking for is that this market should come back to this other block if you must buy. Now, so this is now what happened. So this is a point of interest. If you must buy because the market is what? An uptrend. Am I correct? Something like that. So because I'll take my trend line from this point, right? Probably even targeting here. Okay. So this is my market, as it were. So what you're looking for is very simple. Oh, the market, where will you come back to this point? So I will buy. So that means you have an unmitigated area of interest, which is your, but along the line, we have some kind of other point of interest. Remember, we say we have different type of point of interest. Then this is a fair value gap. Will this market respect this and return back? Then you want to see, okay? Then another thing that makes this guy very strong, you have this other block and you have preceding what we call it, a fair value gap in front of it. So we have fair value gap in front of it. And now this is what we call liquidity void. So the market needs to travel back here. Now see why we sold that last week. We sold last week because of this. This was this close, and we have this candle. That's what we call out of 3. And we now say most swing traders don't waste time, entering this one. I haven't concluded this. So you can now see after this fellow have entered the market, a stop loss a little bit above the wick. It's going to give 50 pips as a stop loss. Let's look at it. Returning back to this point is already 2.4 to 1 ratio 2.4. That's big, and that can give you confidence to actually, if it's going to get to this point, almost 3. You get it now? Now, so that means the profit target will be here. Now, once the market return back here, you want to be looking for a buy. Very simple. Very simple. Now, but this is it. No, this is a swing. If you return back to a lower time frame, remember I will say we're looking at all this other block. Now, if you return to back to 4-hour time frame, you're still going to find similar thing, okay? You're still going to do a similar thing by finding a structure. So for your 4 hours, you can see that this is still a break of structure because these are external break of structure. Look at this, okay, over here on 4 hours. This is a high, this is a low. This is not the high because this is higher. All this one internal structure, then a breakout. Okay, you have this break and immediately return back here. So we have all of this squeeze, but these are internal structure. So we have this is the high and this is the new low. So coming back to actually mitigate all of these point of interest or other block. Sorry, yes, your origin. So now this market you can see now, see what it is. Now we're looking at, so but all of this point of 4 hours looks like, this is a fair value gap of 4 on 1 on daily time frame. So the market is crazily because we saw the strength of dollar was weakening. That's another fundamental macro information that could give you more confidence to actually sort this market and then taking your profit. Ultimately, you are waiting for the market at this region. Now you see now that's a point of interest, okay? Now in the same way is the same direction or dimension for daily time frame. 1 hour time frame. So just that the 1 hour time frame, you will have been getting in and out, even all of this. See, look at it. This 1 hour, look at it. This is a pullback. So before the market actually broke this structure, you're on this 1 hour. So you will have been in the trade sequence in a sequential order. So now let me take another instrument. So this is just very simple. Then another thing we do with this market that's very simple. So you can see it. And I say sometimes if you're just an intraday trader, day trader and intraday trader. So look at Euro USD. I told people to buy. Now when I come on daily time frame, you don't waste too much time there. Now if you come on daily time frame, it gave us the same power of 3. In fact, like CRT, right? Like CRT. Look at this first candle. So like this is the range candle. Look at it here. This candle, this is the range. And again, it's the form power of 3. So since it's the range, what do I do? As this candle closed, this is like, that's 3 days. I haven't seen this one. Today I came. I'm not going to enter today. I will enter tomorrow. Exactly when this candle has closed. But when this candle has closed, what we do now is to go down to a lower time frame, even 5 minutes, 1 minute, and see a market structure shift that was created by this candle. So if I step down to 5 minutes, you're going to see that there are market structure shift or other block or whatever thing that was created by that candle that moved down, and that will have prompted a quick sniper entry into the market. However, now if that is established, then if you go to a 1 hour, the same thing. So you can see now that, okay, as the market has given what it wants to give, you can see that the market continues to move. So now, most time when you are trading this type of market, it's very simple. When you are finding the direction of the market, the point of interest is another major point for you. So let's look at this. Let's look at this market here. So the market has actually got rejected and sell it down. Now, what you want to wait for, say, first, you have seen the structural bias. You are bearish. Oh, okay, I'm bearish. Okay, fine. So the market now is going down. I mark my, break of structure, and then looking at kind of point of interest, that is origin of this market. So that means the last bullish candle before the aggressive move of the market, right? So if that is the case, that should be displaced now to this point. And then this is a break runaway. So now we use combination with what? Fibonacci retracement. So I'm going to take my Fib retracement. Okay, sorry, this is not my Fib retracement. Okay, so let's close this one. So I'm going to take my Fib retracement. Fib retracement. Okay, this is the standard one. So I'm going to take the standard one. So I move back here. So see what happened on the standard one. So there are three major conferences that we found here now. Many wouldn't know. There are three major conferences that work out at this point at the end of the day. Now, this market, now this is the place of origin. Now look at what happened. We have a very bogus fair value gap from here to this point. Can you see now? So since we have this fair value gap, where do I enter? We say locate 50% of that gap. So that's where I use what's called gum box, and then I measure from the high to the low to identify my 50 retracement level. Now, but what has happened? What has helped you here? Oh, okay, sorry about that. The Fibonacci retracement itself had surfaced a help. Why? See your 60% from 50 to 60%. Then after that, what happened? You're going to go to lower time frame and see the reaction of the market. So we can't go there now. So, but with this, all this one, 50%, and then 50 to 61%. Now, assuming you are taking an entry from the golden zone, which will be 50 and 61. So stop loss usually to be here. But for me, because since I have this FEG, my stop loss above that point, right? That's about how many pips? 34 pips as a stop loss. No. 1:2 risk reward. That will have been done here. Okay. So that is how you actually locate your trade on swing level with all of this. So we swing this last week and the market still continue. Yes. Now look at this one now. This is 1 hour time frame. You have a neat break of structure here. You have a very neat break of structure here. And then the market, this is the major origin though. But there's something here, there is another block here, opposing candle. So are we going to have this a bounce? So if you look at it, are we going to have a bounce from here? Maybe yes. So what do I do? If I go to a lower time frame, maybe 5 minutes or 15 minutes, just what I want to see is the power of 3. So this is so confusing, right? So you didn't have a very clear power of 3 as it were right now. So it's still very, very, very dangerous. So that means the market probably may come down to this origin before buying up. So to trade this is very simple, like I've told us, right? And then it's a gradual process, and then you can learn more over time by studying most of those training and videos I've made available. And then, so that is intraday for you. So combine both, to locate your order block and all of that. So you can always find your trade continually working with those strategies. All right. So you don't need to find it difficult at all. If you have any challenge and you are within my Forex inner cord, of course, you can always chat with me directly and ask questions and all of that. So thank you very much. Do have a nice day. Bye for now.